To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Hi dear students, today we are going to do the Negotiable Instrument Act of 1881. Now this is a very old act. It is an 1881 act. More than 100 years have passed since this act came into force. It actually came into force on the 1st of March of 1882. From that day onwards, this act has been applicable. Now as of now, this act has 148 sections in total. Some of the sections have been omitted, the others have been slightly modified, but this act is still active. It is still very practical and it is very useful for all the businesses across our nation. So we will be covering all of these relevant sections from section 1 to section number 148 in this chapter. Now in this chapter, we are going to understand exactly what a negotiable instrument is, what are the different types of negotiable instruments. We are going to talk about promissory notes and the bill of exchange and the check, and how these are applicable, how these negotiable instruments actually bind the different parties attached to this negotiable instrument. So why is it so relevant? Why are negotiable instruments so relevant even till date? All of that is going to be discussed in this chapter. Now before we dive into the sections of this chapter, let's first understand why is the need of this chapter. Why is there a need of negotiable instruments in the first place? Let's take a small example to understand the need of the negotiable instruments. Now you must be going for your articleship. Now in this articleship, which is your CA articleship, let's assume that your principal employer is paying you 5,000 rupees of stipend every single month. So now you use this 5,000 rupees of stipend every month for your lunch expenses. Every single day at the lunch time, you go outside your office. Near your office there is a beautiful canteen. Now this canteen serves some lovely South Indian dishes. It serves some really nice dosas and idlis and mendu vadas, and you really like South Indian food. So every single day at 1 PM you go to this particular canteen and you buy some dosas or some other foods that you really like from this cafe. Now, every single month you pay some of the amount from this 5,000 rupees of stipend that has been given to you. And now, because you're going every single day, this person who works in this cafe, he also knows you. In fact, every single worker of that cafe actually knows you. They know that you work in a nearby office and you are the article over there, you are doing CA and you come every single day. They also know your favorite dishes. So basically, you are well known over there. Every day you go and buy some food from that cafe. So every day you spend roughly around 100 rupees or 200 rupees from your stipend to pay for the food that you purchase during lunchtime from this cafe. Now in one of the month, what happens is, by the 25th day of the month, your entire 5,000 rupees of stipend is over. You don't have any more stipend left to pay the money for the lunch that you will be buying. On the 26th day, you still go to the cafe during your lunchtime because of course you need to eat the food. On the 26th day also you go to the same cafe. Now here you already know the owner of the cafe. So you ask the owner of the cafe whether you can actually buy this dosa without paying the money for now. You try to convince him that, listen sir, I really need to eat the food and you already know me, I come every single day, I pay every single day, I am so good and well behaved person. So if you can just give me a dosa for the next 5 days, I am going to pay you the money positively the moment I am going to get the stipend. And it is the 26th day of the month. So within 4 or 5 days, I am going to get the stipend from my principal and I am going to return you back this entire money. But for now, can you give me some dosas on credit? So here the owner of the shop says that yes, don't worry, I know you very well, you're a good boy, and where are you going to go? At the end of the day, you are still staying and working in this nearby office, so you can't run away. So don't worry, you can sit and you can eat your dosas, enjoy your meal, and you can pay me back the money later. But I will need you to give me some sort of an assurance. Now see, after 5 days, if something happens and you refuse that you ever came here, I need you to at least tell me right now that you will actually pay me the money. So why don't you just write it down on a piece of paper and sign it that you are going to pay for the next 5 days of food after you get the stipend. Now this is a very simple condition. So you agree to this condition because you don't have any intentions to run away anyways. You want to pay the money here, it's just that you don't have the money right now. Whenever you are going to get the stipend, you will definitely pay. So your intentions are very clear. So therefore you don't have any problem in actually giving out a promise in writing that you will be paying this money. So first you calculate the amount that you will have to pay. So let's assume that one dosa is for 100 rupees. So then 5 more days are left. So you will have to pay 500 rupees for 5 dosas that you are going to eat in this shop for the next 5 days. So accordingly, you take a piece of paper and on that you write that I, and then you mention your name, and then you write promise to pay 500 rupees on the first of the next month. You specify the exact date on which you are going to pay this money to this person. And then you also write that this money is going to be paid to the owner of this shop. You mention the name of the owner of the shop, and under that you sign your name. Now this is a small sheet of paper that you prepare, and then you hand this paper to the owner of the shop. Basically through this paper you are actually promising that you are going to pay this 500 rupees as soon as you get the stipend from your employer. Now this owner takes this paper and he is also very happy, you are also very happy, you enjoy your dosas, and for the coming 4 to 5 days also you enjoy your dosas. The next month, on the 1st or 2nd of the next month, you receive your stipend again from your principal employer. Now out of this you already remember that you will have to pay 500 rupees to the owner of that shop. So on the 1st or 2nd of the next month, whenever you actually go back again to the same shop, what happens is that the owner of the shop, he tells you that listen, you told me you are going to pay the 500 rupees. So now it is time that you clear your bill. So what are you going to do? Out of the stipend that you have received, you will pay 500 rupees to this owner of the shop. So this is a very simple transaction. Most of these kind of transactions also happen in day-to-day lives. All the time we don't have the money to actually pay to the shopkeeper or whoever is selling us the goods or the services. In that case, certain times we write down these kind of things on the sheet of paper and we kind of promise that we are going to pay the amount in due time. This example that we just discussed, it is a very practical example. You can relate it with your real life as well. Many a times it might be happening in your real life that you actually need certain goods or services, but you don't have the cash to actually pay the shopkeeper. In that case, sometimes you might actually say that I am going to pay it after some time. Sometimes that shopkeeper might ask you to give it in writing that you will be paying this amount later on. Generally, when we talk about real life situations between us and some shopkeepers who are giving us some goods and services, then generally if the amount is very small and we are known to them, in that case they will simply accept some sort of an oral promise. So even if sometimes you go to a shop, you want to buy something but you don't have the money, but that shopkeeper knows you that you live nearby and you come on a regular basis, then he might actually give you the goods and services for free for the time being. Basically you will have to pay the amount later on. So they can give you these goods and services on credit. Now for that, merely your oral promise might be sufficient. You can orally just tell them that after 1 week you are going to pay the amount, or tomorrow you are going to pay the amount, and the shopkeeper is going to give you those goods and services. Sometimes this might happen. Some other times, if suppose you are a new customer to a shopkeeper, or maybe if you are taking the goods from that shopkeeper which are of a very high value, then in that case merely an oral promise might not be sufficient. In that case, if suppose you are buying a beautiful big sari and that sari costs 25,000 rupees, then in that case if you merely promise the shopkeeper that I am going to pay this 25,000 rupees next week, then is he going to actually give you that sari? Well, the answer is no. He will actually want you to give it in writing that you will actually pay this 25,000 rupees to him. So generally when there are new people involved in some sort of a business, or where there is exchange of money and new people are involved, or maybe if the amount is really huge, then in that case, in order to establish trust, there is a need for the other person to give it in writing that they are actually going to pay the amount. So for example, in the case of this sari also, you will have to write it down on a piece of paper that after a week you will be paying this 25,000 rupees to the shopkeeper. Now when you write that thing on a piece of paper and you sign it, it basically creates a legal obligation on you. So later on you cannot refuse that you did not purchase that sari. So that shopkeeper can also hold you accountable because you have written it down on a piece of paper and you have signed it. So basically you are promising that you will actually pay this amount of 25,000 rupees to the shopkeeper. Accordingly, if after 1 week you don't pay this amount, then the shopkeeper can actually file a case against you. So this written piece of paper basically acts as a bridge for building trust between two strangers whenever there is a huge transaction involved, whenever there is a huge money transaction involved between two strangers. So basically this piece of paper which builds the trust between these two people, this is called a negotiable instrument. So that is why this negotiable instrument is so important. This one example that we discussed, wherein you were going during your lunch time to a nearby cafe and you did not have the money to pay for the dosas, then you wrote it down on the piece of paper that you will pay 500 rupees on the 1st or 2nd of the next month, and you wrote it down and you signed on that piece of paper and you gave it to the shopkeeper. Now this piece of paper is also a negotiable instrument. Basically through this paper you are committing that you are going to pay this 500 rupees, and also the shopkeeper has this one right through this piece of paper that he is going to collect this money from you on the specified date. So basically there is an obligation created because of this piece of paper. This obligation is your obligation to pay this 500 rupees to the shopkeeper. Similarly, if you see from the side of the shopkeeper, then there is a right which is created for the shopkeeper. Now he has a right to collect this 500 rupees on the specified date from you. These same kind of situations also arise in business. In fact, they are very common in business. See, whenever we talk about any single business, a business owner has to transact with so many different hundreds and hundreds of people on a daily basis. And he actually has to transact in monetary terms with these people. Sometimes he will have to sell the goods to them, sell the services to them. Sometimes he will himself be consuming some of the goods and services from these parties. So on a regular basis, these transactions happen in a business. In moments like this, when such business owners are doing huge deals with certain customers which are actually strangers, wherein this main businessman does not know these strangers, he has to supply such huge amount of goods and services to these people, and huge amounts will also be flowing from such strangers to the businessmen, then there is a huge risk involved. Just because there is huge amount of risk involved in such transactions, because these transactions are with strangers, it does not mean that the businessman is going to stop doing his business. If there is an opportunity, even if such an opportunity is from some strangers, then that opportunity will definitely be taken benefit of by these businessmen. In different types of businesses, whether it be a sole proprietor or whether it be a partnership or whether it be a company, the transactions that these businesses do to earn the profits, these transactions might be entered with different types of parties. It may be hundreds and hundreds of parties. Now all of those parties might not be known to the businessmen. Then in that case, does that mean that the businessman should actually not enter into any such transactions? He should not do business? Just because the customers or the people with whom the business are being done, they are strangers, or if the amount involved is really huge, that does not mean that the businessman will stop doing business with them. The businessman is going to take the risk. He will hedge that risk, and he is definitely going to make some profit out of every single opportunity that he gets. So in businesses also, sometimes when huge amounts of transactions are done with different parties, then in order to minimize the risk involved in such transactions, the negotiable instruments are used. Now what do I mean by that? Let's take a small example to understand this. So suppose we have this one shop. This is a sweets shop. Now this person has created this shop. Now basically here he sells different types of sweets which are regionally created. Let's assume that the name of this man is Mr. Ram. So now Mr. Ram has this beautiful nice sweets shop. Now generally speaking, this person gets random customers from the city. Now these customers are small scale customers. They buy sweets of 100 rupees, 1000 rupees or sometimes 2000 rupees. So that is the general range in which he is doing the business with the citizens of that city. Now one day what happens is, some foreigner, let's assume that his name is Anthony. Let's assume that this Anthony, who is a foreigner, he likes the sweets so much that he wants to place an order for 1000 kgs of these sweets that need to be exported. So he wants to do this kind of a business transaction with Mr. Ram. Now here since this is a foreigner, Mr. Ram definitely sees an opportunity. He thinks that he can sell off these sweets at a higher rate. Moreover, there is a huge quantity of sweets which is also involved. So, there is a huge amount of profit that he will be making from this transaction. But then Mr. Ram thinks that he does not know this Mr. Anthony. He is scared that what happens if I actually supply all of these sweets to Mr. Anthony and Mr. Anthony does not pay me a single penny. How is this transaction going to work? What if I deliver the sweets and he does not pay me the money? Now similarly, this is also the situation with Mr. Anthony. Now Mr. Anthony might also be scared that if he pays the entire money initially itself, that means in advance, then what happens if Mr. Ram actually does not deliver these sweets to Mr. Anthony? So both of these parties are strangers to each other. Moreover, the delivery of the goods and services over here is also a huge amount of goods and services. The goods that are involved in this transaction are also really huge in quantity. So the amount involved might also be really huge. So now what these two people can do is they can actually make use of a negotiable instrument here. So what Mr. Ram and Mr. Anthony can do is that they can make use of negotiable instrument in order to reduce their risk. Let's assume that Mr. Ram puts up the price of 1000 kgs at the rate of 1000. So the total price for all of these sweets would come to 10 lakh rupees, that is 1000 kgs into 1000 rupees each for per kg of these sweets. So here Mr. Ram will have to prepare all of these 1000 kgs of sweets and he will have to deliver to Mr. Anthony. Now here what they can do is Mr. Ram can actually ask Mr. Anthony to write it down on a piece of paper that he is actually going to pay this 10 lakh rupees to Mr. Ram on a specified date. He can make Mr. Anthony sign on that piece of paper. In that case, this is going to be called a negotiable instrument. Suppose here Mr. Anthony actually writes it down on a piece of paper that I, Anthony, promise to pay 10 lakh rupees to Mr. Ram on this particular date, and under that written note he actually signs also. Now on this piece of paper, because this is still just a piece of paper, it is not a legal document, what Mr. Ram does is he actually puts a stamp on this piece of paper to make it a legal document. Now this piece of paper is a legal document. This legal document gives a right to Mr. Ram to recover 10 lakh rupees from Mr. Anthony. Now this legal paper also puts up an obligation on Mr. Anthony to pay this 10 lakh rupees on the specified date to Mr. Ram. Now through this piece of paper, Mr. Anthony will be satisfied that he does not have to immediately make the payment of the goods and he can just receive the goods and later on the specified date he can make the payment, that is 10 lakh rupees to Mr. Ram. Similarly, Mr. Ram is also assured that he can properly deliver all of these sweets to Mr. Anthony, and then after that on a specified date he is going to receive this 10 lakh rupees from Mr. Anthony. Otherwise, he can file a case against Mr. Anthony. So here we see that this negotiable instrument is acting as a bridge of trust between this Mr. Ram and Mr. Anthony. Now these two people are basically strangers. The amount involved is also really huge, but they don't want to lose out on this opportunity of doing business with each other. So that is the reason why they reduce their amount of risk by using a negotiable instrument. So from this example, you understand that at different facets in different types of businesses, we require these negotiable instruments to reduce the risk of transactions. Whenever the business transactions are done on credit, in that case to ensure that the other party makes the payment, therefore we use these negotiable instruments. Now these negotiable instruments are widely used all over the country in different types of businesses. They are known with different types of name as well. Here in this Negotiable Instrument Act, we are going to study mainly three types of negotiable instruments. The first is the promissory note, the second is the bill of exchange, and the third is the check. We are going to study about these three types of negotiable instruments, and we are going to study how they actually operate. What are the laws relating to these negotiable instruments when such negotiable instruments are being dealt with between two or more parties. Now let's discuss what is the definition of negotiable instruments and what are the different characteristics of negotiable instruments. Now you already understand what generally a negotiable instrument is. So basically between two parties, whenever there is a transaction and money has to be paid by one party to another, in that case if such person does not have the money in that time, then he can write it down on a piece of paper and he can state that he will be paying certain amount on a certain date to a certain person. So basically on a piece of paper, an obligation is created by one party to pay the other party. Similarly, the other party's right is created to collect the money from this first party. So that is what negotiable instrument is. That is what we understand from the discussion so far. Now how has the Negotiable Instrument Act defined this negotiable instrument? Let's read the definition which is given in section 13 first. Section 13, Negotiable Instrument. A negotiable instrument means promissory note, bill of exchange or check payable either to the order or to bearer. So, if we were to define what negotiable instrument is, then we would say that it is basically a written piece of paper through which there is obligation created for one party to pay the amount to the other party, and there is another person's right created to collect this money from the first mentioned party. So, this is the broad definition. But there is one additional feature which needs to be added here to this definition. See, as the name says, this instrument is negotiable in nature. That means it is transferable in nature. It can be endorsed. Therefore, in this definition, we are going to add one more term. This written piece of paper is actually transferable in nature, and through this transferable written piece of paper, basically an obligation is created for one party to pay the money to the other, and the right is created for this other party to collect the money from the first mentioned party. So that is what negotiable instrument means. Now we need to understand what this word negotiable or transferable means actually. Suppose there is a person, Mr. A. Now Mr. A sells some goods to another person, which is Mr. B. Now let's assume that the value of these goods is 10,000 rupees. So when Mr. A sells it to Mr. B, then accordingly Mr. B will have to pay this 10,000 rupees to Mr. A. Now let's assume that Mr. B does not have that money right now. So he is going to get this money after some time from some clients, and he wants to pay this money after some time. So here Mr. B tells Mr. A that, listen, I don't have the money right now. Can I pay this money of 10,000 rupees after 30 days? So here Mr. A says that, okay, fine, I don't mind if you pay me this money after some time, but can you please write it down on a piece of paper and sign it so that after 30 days I can come back to you with that piece of paper and ask for the money? It is just for the purpose of trust. So here Mr. B says that I don't mind writing it down on a piece of paper. So Mr. B takes a piece of paper. On that piece of paper, Mr. B writes that I promise to pay 10,000 rupees to Mr. A after 30 days from the creation of this instrument. Now under this statement, Mr. B signs on that document. Then after that, Mr. B delivers this document to Mr. A. Now Mr. A reads this entire document. Now on this document, it is very clearly stated that Mr. B is promising that he is going to pay 10,000 rupees to Mr. A after 30 days from the creation of this document. Now this document is a simple instrument through which Mr. B is promising to pay Mr. A 10,000 rupees. Now here Mr. A has a slight bit of problem with this document. Now Mr. A thinks that, listen, you are going to pay me after 30 days. Now what happens if I actually need this money within 15 days only? I might need this 10,000 rupees after 10 days or 15 days. I can't wait for 30 days for you to deliver me this 10,000 rupees. So why don't you just write on this piece of paper that you will actually pay this 10,000 rupees to me, that is Mr. A, or you will also pay this 10,000 rupees to any other person that I tell you to pay. So here Mr. A tells Mr. B to write it down on a piece of paper that he is going to either pay Mr. A this entire 10,000 rupees, or if Mr. A wants Mr. B to pay it to someone else, then Mr. B is going to pay that amount to someone else. So that is what Mr. A tells Mr. B to write on that piece of paper. So accordingly, Mr. B takes another piece of paper. On that piece of paper, he writes that I, Mr. B, promise to pay Mr. A or order of Mr. A rupees 10,000 after 30 days from execution of this instrument. Then under that Mr. B signs. So what does this instrument basically mean? Now this instrument basically means that Mr. B is promising that he is going to pay 10,000 rupees after 30 days, but he is going to pay this 10,000 rupees to either Mr. A, or in case Mr. A wants Mr. B to pay this amount to someone else, then Mr. B is also going to agree to pay that much amount to someone else. So that is what this instrument states. Now here this instrument becomes a negotiable instrument. Now let's see the applicability of this instrument. So here we know that Mr. B is going to pay Mr. A after 30 days. So as of now, he is not making the payment, he is going to pay after 30 days. Now during these 30 days, one day what happened is that Mr. A wanted to buy some goods from some other party, Mr. C. So accordingly, Mr. A went to Mr. C to purchase some goods. So Mr. C delivered those goods to Mr. A. Now the value of those goods was 10,000 rupees. So here Mr. A had to pay this 10,000 rupees to Mr. C. But that time Mr. A did not have the money. So what Mr. A thought? He thought that let me transfer this negotiable instrument which I have received from Mr. B to Mr. C. Accordingly, after 30 days, when it is time for Mr. B to pay this amount, then instead of me, he can directly pay it to Mr. C. So accordingly, Mr. A takes out from his pocket this one instrument that he has received from Mr. B. On this instrument, it is very clearly stated that after 30 days, B is going to pay 10,000 rupees to either A or to the order of A. So accordingly, Mr. A gives this instrument to Mr. C. Mr. C also takes this instrument, and when he reads this instrument, accordingly he knows that after 30 days, there is some person who is going to pay the money. Now he is going to pay directly to C instead of A. So here Mr. A has to pay Mr. C this 10,000 rupees. So instead of paying the cash, he actually decides to give this negotiable instrument which he has received from Mr. B directly to Mr. C. Accordingly, after 30 days, this Mr. C can directly get this 10,000 rupees from Mr. B. So basically here this negotiable instrument is acting like a way of paying the other party. So instead of paying actual cash, this negotiable instrument is being transferred from one party to the other, and the same legal rights are going to be applicable on Mr. C also. So just like when this instrument was with Mr. A had this right to collect this 10,000 rupees from Mr. B. Accordingly, when this instrument is then passed on to Mr. C, accordingly now later on after 30 days, Mr. C is going to have this right to collect this 10,000 rupees from Mr. B. But now from the face of the instrument, we won't know that actually who is holding this instrument. So here therefore there is a proper endorsement that needs to be done. Now as you can see on this negotiable instrument, the words that were written was B wrote that B promises to pay either A or order of A 10,000 rupees after 30 days. Now this basically means that either he is going to pay it to A, or if A has ordered someone else to take this money from Mr. B, then he is going to pay it to some other person. So now here A will have to make the order of paying this money to someone else. So how is A going to do that? So for that, A will have to write it down on that negotiable instrument itself that he is ordering that this amount has to be paid to someone else. He will have to make an endorsement on that negotiable instrument. If he passes this negotiable instrument without writing anything down on that negotiable instrument and he gives this instrument to C, then later on after 30 days, if Mr. C goes to Mr. B and shows him that negotiable instrument and asks for the money, then Mr. B might think that Mr. C has stolen that negotiable instrument, because Mr. A never told anything to Mr. B. So accordingly, what is the exact proof that actually Mr. A wants this payment to be done to Mr. C? So in order to prove that the payment by B should actually be done to Mr. C, therefore Mr. A will have to write something down on that negotiable instrument itself. So what Mr. A can do here is, when he is purchasing the goods from Mr. C, at that time when he will be giving this negotiable instrument to Mr. C, then before giving it to Mr. C, he is going to take that negotiable instrument, he is going to turn it around, and behind it he will write payable to C or order. And then after that he is going to make a signature. So A is going to sign after that. Now this is a valid way of endorsement. Through this, A is basically writing it down on this negotiable instrument that now on, the right to collect this money does not belong to me. Now this right to collect the money goes on to Mr. C. So then accordingly Mr. C has this right to collect this money after 30 days from Mr. B. So this is a way in which Mr. A can order the payment to be done by B to some other party. Now here also, as you can see, it is very clearly stated that it is payable to C or order. So now Mr. A is going to write payable to C or order, and then Mr. A is going to give his own signature near that endorsement. Now once that is written down behind the negotiable instrument, then that negotiable instrument is going to be given by Mr. A to Mr. C. Now Mr. C is going to hold this negotiable instrument. Basically he wanted 10,000 rupees to be paid by Mr. A. Instead, now he is going to hold this instrument. Then after 30 days, he can directly go to Mr. B and ask for the money. So let's assume that after 30 days, Mr. C actually goes to Mr. B and he asks for this money, which is 10,000 rupees. So Mr. B will now have to pay to Mr. C. So before paying, Mr. B is going to check that negotiable instrument. Now behind that negotiable instrument, it is written that it is payable to C or order, and near that Mr. A has made the signature. So by seeing that instrument, Mr. B will realize that Mr. A wants that the payment has to be done to this other party, which is Mr. C. Accordingly, Mr. B is going to pay that 10,000 rupees directly to Mr. C. Accordingly, this instrument is going to be satisfied. The payment will be done for this instrument. So as you can see, this instrument was originally executed between two parties, which is Mr. A and Mr. B. But then it got transferred to another party, which is Mr. C. So here we can see that this instrument is transferable in nature. Now here Mr. C could have transferred it also to some other party. Suppose before 30 days, Mr. C has also purchased some goods from some other party, Mr. D, and those goods were also of 10,000 rupees. Then in that case, if it is before 30 days, that means before the maturity period of this instrument, if Mr. C wanted to pass on this bill to someone else, then he could have also done that. So here Mr. C could also have transferred this negotiable instrument to some other party, Mr. D. So here when Mr. C wanted to transfer this instrument to another party, Mr. D, then what would he do on that negotiable instrument? He will also have to write some instructions. Now if you remember, when Mr. A was making the endorsement in favor of Mr. C, what did he write? So he turned that negotiable instrument around and he wrote that it is payable to C or order. That means this instrument is payable to either C, or in case C wants the payment to be done to someone else, then it is going to be paid to some other party. So that means now the right to make this endorsement lies with Mr. C. So here he is going to turn around that negotiable instrument again, and under the first endorsement, he is going to make the second endorsement. He is going to write payable to D or order, and after that he is going to make his own signature. So C is going to sign that. Now from the reading of this instrument, what can you understand? That primarily this bill was drawn between Mr. B and Mr. A. Then after that Mr. A transferred it to Mr. C and he wrote that it is payable to C or order. Then after that Mr. C transferred it to Mr. D and he wrote behind it that it is payable to D or order. So now this instrument will be given by Mr. C to Mr. D. Now Mr. D is going to hold it for 30 days. After that, whenever the date of maturity actually comes, then Mr. D is going to go to Mr. B and he is going to ask for this 10,000 rupees. So will Mr. B have to pay this amount to Mr. D? Well, the answer is yes. First, Mr. B will have to see this instrument. So when he sees the instrument, behind that instrument, he is going to see that Mr. A has first of all endorsed it to C or order. And then Mr. C has actually endorsed it to Mr. D or order, and both of them have actually signed it. So that means this negotiable instrument legally belongs now to Mr. D. Accordingly, Mr. D should be given the payment. So here Mr. B is going to make the payment to Mr. D. So accordingly, this instrument is going to be satisfied. So here we see that this negotiable instrument can be transferred any number of times. This is basically a negotiable instrument. That means it is a transferable instrument. The rights relating to this instrument to collect this money, these rights can be transferred to any legal party. Hence we call this legal instrument as a negotiable instrument. So now you exactly understand what negotiable instrument is and generally how this operates. In this chapter, we will understand that negotiable instruments are basically of three different types. They can either be promissory notes, or they can be bill of exchanges, or they can be checks. Now what these are exactly, we are going to understand them in depth after some time. But as of now, you know that negotiable instruments can be of these three types. Now in this example that we were discussing, B was basically promising that he is going to pay to A or order. So here this was a particular example of a promissory note. See, promissory note is wherein one person is promising to pay a certain amount to a certain person or his order on a specific date. So whenever there is a promise by one person to pay the amount, then that is called a promissory note. We are going to study in depth about it after some time. In this particular example, we were dealing with one type of negotiable instrument, which was a promissory note. So now let's try to define negotiable instrument. So we can say that negotiable instrument is basically a written document which is transferable in nature and through which basically right is created of one party to collect the money from the other party, and obligation is created for the other party to pay the amount to the first mentioned party. Now let's repeat, it is basically a written document which is transferable in nature and which creates a right of one party to collect the money from the other party, and it creates an obligation of the other party to pay the sum to the first mentioned party. So that means there are basically three features of a negotiable instrument. Now whether it be a promissory note or whether it be a check or a bill of exchange, if it is a negotiable instrument, it has to first of all be in writing. Merely an oral promise done by one person to the other stating that he is going to make the payment after some time, that is not sufficient. When we talk about negotiable instrument on which this entire Negotiable Instrument Act of 1881 is going to be applicable, then we only and only talk about the written documents wherein one person's right is created, the other person's obligation is created. So first of all, it has to be in writing. The second feature of a negotiable instrument is that one party's right is created, the right is to collect the money from the other party, and the second party's obligation is created to make the payment to the first mentioned party or to his order. So basically rights and obligations of parties are created through this instrument. So that is the second feature of a negotiable instrument. The third feature of these negotiable instruments are that they are negotiable. That means they are transferable from one party to the other. So as we discussed, initially the right was for Mr. A to collect this money from Mr. B. Later on, this right got passed on to another party, which is Mr. C, because this instrument was transferred by Mr. A to Mr. C. Accordingly, Mr. C had the right to collect this amount from Mr. B. Then after that, Mr. C also endorsed it to another party, Mr. D. So accordingly, Mr. D had the right to collect this amount from Mr. B. So here we can see that this instrument can be transferred from one person to another. Similarly, the right to collect the money is also transferred from one person to another. Now, how many times can this instrument be exactly transferred? Can it be transferred 100 times? Can it be transferred 1000 times to 1000 different parties? Can it be transferred 1 lakh times to different parties? Well, the answer is yes to all of these. See, there is no limit which is given in the Negotiable Instrument Act with respect to the transferability of this instrument. So, it can be transferred any number of times to any number of parties. Although in practical scenarios that does not happen. In practical scenarios, it may be transferred to at the most 10 people or 15 people. But according to law and according to this Negotiable Instruments Act of 1881, there is no bar on the number of transfers that can happen for this negotiable instrument. So, infinite number of times this negotiable instrument can be transferred to different parties. So, these are the three main features. It has to be in writing, then rights and obligations are created because of this instrument, and this can be transferred from one person to another and to many different people in fact. So basically it can be transferred infinite number of times.